Hi, I'm William,
And I'm Kat,
and that means this is Info on the Go.
answering questions you want to know.
So today we're going to be talking about the stock market, and we're going to give a glossed over view of the stock market and some investing strategies. You want to kick it off, Kat?
Ooh, all right. What is the stock market? A stock market or equity market is an exchange where shares of publicly held companies are issued and traded among investors. Companies use stock markets to raise capital from investors who purchase stocks of these businesses on the exchange. Individuals and financial institutions alike can also invest in businesses in order to share any possible profits they might bring forth.
Stock markets first appeared in European cities during the late 1700s, followed by their introduction into the newly formed United States. In 1792, that's 1792, on Wall Street in New York City, early trading activity largely consisted of government bonds and bank stocks before 1817, when the New York Stock Exchange officially launched with trading stocks of insurance, banking, and coal companies located along the East Corridor.
Stock market terms. Before we move forward, let's establish some definitions of some commonly used terms on the stock market. Stock. Stocks are sold public traded companies. Stocks are sold by public traded companies to raise capital they need to ensure the daily operations of the company are carried seamlessly without any type of financial glitches. Apart from raising capital, the owners of the company may also want to avoid selling their businesses in order to pay investors who initially invested in their ideas. Investors can offer their percentage of shares for sale, and their return may be higher or lower based on the market sensitivity at the time of selling. The sale of stock is a form of equity financing that does not involve the highest interest rates associated with debt financing, borrowing money through a loan. The sale of stock may also be a form of encouraging top performing employees to invest in the company by their share ownership.
A share. A share of stock gives buyers some type of ownership in a company depending on the number of shares they buy. With the share of the stock buyer may be entitled to some assets of the company. Those that acquire the shares are referred to as stockholders and shareholders. And just a side note here, I know we've all seen movies where hostile takeover, somebody buys 51 shares of a company and takes it over. That's kind of what we're talking about here, where they have some type of ownership. Some stocks will let you vote in their on their board, some won't. Initial public offering. An initial public offering, also called an IPO, essentially happens when a company moves from private to being public so that it can offer shares to the general public. The IPO offering is part of the primary market. A secondary IPO occurs after the initial IPO, and the time frame is established according to the company's needs and governing regulations. The secondary IPO is part of the secondary market, and that is confusing, I know, but basically, a company can give an initial IPO, and then as it moves into its public trading, it can offer another IPO to the general market. The second IPO usually is generally lower than the initial.
So, Dow Jones Industrial Average, often referred to as the DJI or simply the Dow, are indicators within the United States that measure the different sectors such as industry, transportation, and utilities. They are used to track the stock exchange by using the best companies to represent the main industries considered in the indice indice calculations.
And dice calculations. A bull market. Whenever the economy is growing, investors refer to this as a bull market. The bull is running. That's the easiest way to put it. This is commonly caused by progress through business development in different sectors that impact the economy. In the bull market, investors take advantage of the rising stock prices with the sole intention of capitalizing on the good financial climate A rise in stock occurs when the demand for a good or service is more than the available good and service, as explained below. You can take on bear.
Bear market. The bear market is the contrary of the bull market, where the economy presents a stagnated or slow development profile. During this period, investors usually consider investing in bonds instead of stocks because the uncertainty of the market in the bear market, stock price fall considerably.
There,
Um,
go ahead.
there are two major stock exchanges in the US: the New York Stock Exchange, the NYSE, and it's based in New York, founded in 1790. The National Association of Securities Dealers Automated Quotation System.
Also
That's a
known as
mouthful.
the NASDAQ.
NASDAQ. Okay. Unlike Amex, Amex.
Yes,
Okay.
Amex.
The NASDAQ is the largest electronic screen-based market created by the National Association of Securities Dealers in 1971. It is popular because of its computerized system and relatively modern as compared to the New York Stock Exchange. It currently offers lower listing fees than the NYSE and includes some of the largest companies such as technology giants Apple, Google, Amazon, and Microsoft.
And at the time when I was researching this, the New York Stock Exchange still is becoming more computerized, but they still have traders on the floor. The NASDAQ is basically computerized, and you'll find a lot of technological companies on the NASDAQ versus the New York Stock Exchange. So I guess really, how do we buy stock? So step one is you got to open a brokerage account. Opening a brokerage account is the first step in buying stocks, since you can't buy stocks directly from the exchanges, I guess I should say. There are two main types of online brokerage accounts: full service brokerages and do it yourself discount brokerages. Most brokerage firms also have some kind of investing tools or apps that you can use from your desktop or mobile devices, which make it simple to buy stocks and monitor your positions while you're on the go. And positions is a term. When you buy a stock, that's a position that you have a position in that, not a position in that company, but you have um, positions. As you have multiple stocks, you're going to have different positions as you go, right? Is that the
Mm-hmm.
best way to explain that?
Yeah.
Okay.
And then step two is decide what stocks you want to buy. Owning stock means you own a slice of a company. And because there are thousands of stocks available to purchase, it's important to research those you want to buy before investing money.
Yes. Decide how many shares you want to buy. Most most shares they can run from a few dollars to hundreds of dollars to thousands of dollars. So look at the company you want to buy, figure out how many shares you can buy. As you research stocks, you should also have a strategy, a reason to buy and a reason to sell. This can help influence how many shares you want to buy at first.
And then step four, choose your order type. There's market orders. A market order sends buying instructions to the brokerage to purchase a stock at the best available price. This type of order may be fine for stocks that have a lot of trading activity and thus little difference in the price between where someone is selling the stock and where there is a willing buyer, known as the bid-ask spread. For thinly traded stocks, there may be a wide discrepancy between the spread, and you may not get the price you last saw quoted on your screen.
And to just put that in perspective, let's just say that Kat and I have a company and it's called Info on the Go. And we're selling shares of stock that go from $1 to $2 in a day and could possibly go back down to $1. To place a market order, you would say, I want to buy a share of Info on the Go when it reaches $1.50. And as soon as it reaches $1.50, that person on the New York Stock Exchange or the NASDAQ is going to hit it, and you're going to own that share for that price, whether it goes back up or down or not. And then that's kind of what you're talking about there, market orders. It's only going to
Yes.
buy it at the price that you designate.
Right, right. Which
Um,
which can be good or bad depending on how the market swings.
Absolutely. Limit orders. A limit order lets you choose the price in which you buy stock. Oh, maybe I had that backwards. Well, no, I didn't. A limit order chooses the price in which you buy stock. If a stock is trading for $50 and you think it's worth 40, you can put in a limit order that tells the broker to only buy the stock if it hits $40 or less. Limit orders help avoid surprises when buying stock and especially thinly traded ones. Yes, I had that wrong. So market orders instructs the brokerage to buy that particular stock, and it depends on when the brokerage firm buys the stock, depends on what price you have it at. Limit orders tells them what to buy it at. That's I messed up. Sorry.
Gotcha. Gotcha. It's all good. So, order parameters. In addition, you can put more parameters around limit orders. Good for day. As a request to let the trade expire if the price target isn't reached during the trading day. Good till canceled. Is a resting buy order that will be filled when a stock's price reaches the limit price or until you cancel the trade.
Step 5, place your order with the brokerage. And that's it. That's how that works. And selling a stock is done exactly the same way. We're gonna take a moment and we're gonna talk just a little bit through some different types of funds. So we're going to talk about mutual funds now. A mutual fund is a pooled investment vehicle where money from multiple investors is combined to invert in a diversified portfolio of assets, such as stocks, bonds, and other securities managed by a professional fund manager. Okay, so a mutual fund is basically just a compiled bunch of stocks or bonds or securities or whatever they are, but it's diversified, right? It's not just one. It's a basket full of stuff that you own. And depending on how the group does as a whole, depends on how much money you make or how much money you lose.
Right. So, a bond is a fixed income investment where an investor lends money to a borrower, typically a government or corporation, for a defined period in exchange for regular interest payments and the return of the principal at maturity.
A commodity is a basic good or raw material such as gold, oil, wheat, coffee, that is interchangeable with other goods of the same type and is often traded on exchanges.
A future is a standardized financial contract obligating the buyer to purchase or the seller to sell an asset like commodities, currencies, or financial instruments at a predetermined price on a specific future date.
Now we'll talk a little bit about trading strategies, and again, this is just a gloss over. So, trading strategies are approaches that investors or traders use to make decisions about buying and selling financial assets in the stock market. Here are some commonly used trading strategies.
1. Day trading. Description. It, in- it involves buying and selling stocks within the same trading day to capitalize on short-term price movements. The key features are no positions are held overnight. It relies on technical analysis, chart patterns, and market news. Requires a fast-paced approach with constant monitoring. And it's for experienced traders with a high risk tolerance.
And I think a lot of day trading is done computerized models with different algorithms nowadays.
Hmm.
Swing trading. It focuses on capturing short to medium term gains over a period of days to weeks. Its key features uh, relies on technical and fundamental analysis to identify trends. So basically, it's a trend trader. Um, Traders hold positions for a longer time compared to day trading, but still aim for quick profits. This is for intermediate traders with some market experience, but still kind of like on an expert level.
Uh, Position trading. A long term strategy where traders hold stocks for months or even years, aiming to profit from large price movements. The key features are less focus on short-term fluctuations, relies on fundamental analysis to assess a company's financial health and growth potential, and it's for investors with long-term outlook and patience.
Scalping. It's a high frequency trading strategy where traders aim to profit from small price changes. Its key features: trades are executed in seconds or minutes, relies heavily on technical analysis and high trading volume, requires tight stop loss orders to manage risk. And this is for advanced traders with access to fast trading platforms. Again, those algorithms we were talking about.
All right, so we got value investing, and it involves buying undervalued stocks with strong fundamentals and holding them until they reach their fair value. It's inspired by Warren Buffett and Benjamin Graham, and it focuses on financial metrics like price to earnings ratios and intrinsic value. It's for long-term investors looking for steady growth.
And that goes back to that research because you can have a stock that's undervalued
Mm-hmm.
and you kind of invest in it. That's what they're talking about there.
Right.
Growth investing um, targets stocks of companies expected to grow significantly in revenue and earnings. Often focuses on technological and innovation sectors. Investors are willing to pay premium for future potential. This is for risk takers, risk tolerant investors aiming for high returns.
And then we got momentum trading, which involves buying stocks that are trending upward and selling when they lose momentum, which can also be a little risky, in my opinion.
Yes.
Relies on technical indicators like moving averages and relative strength index. Aims to ride the wave of market trends and is for traders who can identify and quickly act on trends.
Dividend investing, it focuses on buying stocks that pay regular dividends to generate income. Um, Looks for companies with strong history of dividend payments. Often includes blue chip or utility stocks. This is for the conservative investor seeking steady income. So you're not really worried about the fluctuating price of the stock because you're going to get that dividend, which is a paid out. Sometimes they're done quarterly, sometimes they're done annually, but they're consistently paying. And you'll see a lot of the Fortune 500s with that.
Mm-hmm. Contrarian investing, and it involves going against the crowd by buying undervalued stocks during a market downturn or selling undervalued stocks during a bubble. The key features are contrarians believe the market overreacts, creating opportunities, requires a strong understanding of market psychology, and it's for investors with high risk tolerance and patience.
Option trading uses derivatives like call and put options to profit from stock price movements without owning the stock. Includes strategies like covered calls, protective puts, and straddles. It's for high risk and complexity, but offers significant profit potential. This is for advanced traders with knowledge of um, derivatives.
Algorithmic trading. It utilizes computer programs to execute trades based on preset criteria like price, volume, or time. And the key features are it minimizes human emotion in trading, requires programming skills or access to trading algorithms, and it's for institutional traders and tech savvy individuals.
So, how do you choose your strategy? You got to understand your risk tolerance, understand how much risk you're willing to take on. Time of commitment. Day and swing trading require active involvement, while investing is more passive. Market knowledge. Beginners might prefer simple strategies like dividend or growth investing, while experienced traders might explore day trading or options. Um, Really, you just want to be what's comfortable for you. If you're wanting to get into the stock market, you know, Apple is a good company to invest in. You got technologies like oil, gas, electric, all different kind of companies. I'm trying to think of some that have been around for a while, like Coke. Um, that you just might want to kind of like get into and kind of understand how they work. We didn't really touch on balance sheets or anything, so save your emails. That's part of the research.
Gotcha. Alrighty.
Make sure you like us on Facebook. You can find us on Facebook with at info on the go, Lord.
And make sure you give us a review wherever you get your podcast from.
And I'll let Kat read it for you guys.
All right. Catch you later.
With that being said, that's going to close us out for stock markets.
All right.